last season, we talked about, so season 3, that was about 2 years ago. Did we figure out? I mean, it was a bit, but we talked in that season. That was one of my favorite seasons before this one, of course. But we talked about deal making and deal doing. And that was really fun because we went through a lot of hypotheticals and got to go through the different things that happen when you're putting a deal together and whatnot. But this season, and what I'm really excited about, this episode is where we're going to really kick into real deals. We have an actual deal that we're going to analyze through a couple episodes, and to maybe set it up, Spencer, let's turn it over to you. Let's have Spencer dial this in for us here.
Yeah, so this is going to be fun because we're going to pepper Michael with questions about a project that he's working on. I think it's pretty interesting. And so Michael has a development firm called FirmRidge. Maybe I'll give a little bit of bio for those who don't know Michael that well. Michael doesn't tend to sell himself as much as I do. So, Michael was in construction pre-MBA. He also had this desire to be a rock star.
That's right. I was a rock star.
He was a rock star. He still is a rock star. No, and they toured around in a van until the van broke down. And everything you expect as a rock star.
Really good at the guitar.
And so he did call construction as part of the development process. He goes back to school, goes to Cornell, does a dual MBA and master's in real estate, and we start A.CRE while we're both at Cornell together. And then he comes out and he takes this job at Heinz. It's kind of a highly sought after job. And he won't say this, but I mean, it's in San Francisco working on some of Heinz's more high profile projects, and learned an incredible amount. Michael's the sort of person that is a true craftsman. Right. Mm-hmm. He gets into the details to a degree that many of us don't have the patience to do that. And some of that I'm sure was learned or honed in his time at Heinz. But I'm sure is, part personality, part from his construction days, and learned a ton as working at a big institutional developer as a development professional. Ultimately, though, the more I've we've known each other, a decade now. Michael really is an entrepreneur at heart, and he wants to be out doing his own thing and building his own thing. And so he leaves Heinz and he starts his own thing. Was building some momentum, and then Stablewood comes along, and so he joined me. We started Stablewood with a team, and he helped us launch our first strategy. And a moment came where he realized he wasn't really happy. What he really wanted to be doing is his own thing. I mean, what the reason he left Heinz in the first place. And so he goes back out on his own. I'm still at Stablewood. Michael goes back, continues to build FirmRidge. And he's done several things, which we won't talk about. The other
we might get into it. But
we might get into some of the other investments you're doing. But I think what's interesting for this episode is what you're doing in the RV space.
Yeah,
I find it really fascinating. And the context of my relationship to Michael, besides that we're friends first and partners, co-contributors in Adventures in CRE, is he invited me and a handful of other people in his life to be part of his advisory board. I think.
Yeah.
Non-paid position.
There's a little spiff in the end for your sage wisdom.
A pat on the back. But it's a lot of fun because I hear about what you're doing and I find it fascinating. And the beauty of you being independent, being the sole owner of FirmRidge, you can talk with the audience in more detail about deals that's I can't because I have partners or our other guests can't because of whatever reason. And so we're going to spend a few episodes really getting into the weeds. And I think there's a learning opportunity for many of our listeners. I think some will just find it interesting if you're beyond that. And so let's talk RV. So the first question is what are we even talking about here? What's the strategy that you are launching right now?
Yeah. So first off, incredible recap. You really know me. I felt like you were peeking into my soul a bit. No. So let's talk strategy. I'll give you the direct. What are we doing here at FirmRidge, and what am I so excited about?
our goal right now is we're going out to develop a portfolio of RV parks within 25 miles or 30 minutes of bucket list national parks. And before we get into...
Okay, hold on a second.
Yeah.
So what is an RV park?
So an RV park is a location usually in a place of beauty or desirability where people show up and they take their RVs and they come and they spend a day, a week, sometimes months. Sometimes people live there long term, depending on what the park is open to. And they come together, they spend time with family, they spend time in the outdoors. And it's just it's a place to get away and have an experience for a while out of the day in and day out.
Okay, so we do real estate is the business of space and space use and renting space. So,
yeah.
But from a real estate perspective, what do you own and what are you renting?
Yeah. Okay. So what do you own and what do you rent? So you own land.
Okay.
And you rent that land out, and that's a.
So you're renting pads.
So you rent pads,
okay.
And that's a beauty of this. So what it is it's somewhat of a hybrid of hotel, and you get I kind of look at it as you get all the upside of the hotel without a lot of the risk in the hotel. And what I mean by that is that there's this hospitality sense to the industry, and yet all of the, let's just call it what it is. It's CapEx and maintenance and risk of owning a building that is in place and that you have to manage is not there. So people come in with their own RVs, they come in, they come out, and you're not responsible for any of that CapEx. So it's a beautiful opportunity to just own a piece of land in an excellent location, depending. Obviously, RV parks are everywhere. And so, yeah, it's
so it's like a Hilton or Marriott, except for the building is brought by the guest.
Exactly. So it's like a short-term ground lease, right?
Yeah. So are they by the night, by the week, by the month? Like, what's the term of your lease?
Yeah, they can be anything. They can be by the night, by the week, by the month. And so, and it depends on your strategy. Some of these RV parks, people live there, they sign leases. We're not going to do that. In our strategy, we're short-term.
Yeah.
And that's really by function of location. And you'll see, like, if you look at, Sun Communities, for example, one of their big strategies is to take RV parks and convert them to manufactured housing. And that's by function of location, because the revenue stream in certain locations is a lot higher from long-term rents. Well, if you're by a national park, the revenue opportunity is, many multiples higher because there's such demand for this transient spot.
And for those who follow the podcast, we had Brant Foster on, I don't know, probably a year ago, 9 months ago. And as Michael was doing his due diligence on this national strategy, he developed a relationship with Brant, and that's one of the reasons Brant came on. And it's interesting you talk about that converting to RV, converting from RV to permanent. That's a very institutional strategy. So why are you not doing that? Why are you sticking to called the hospitality model, the short term?
Yeah, it is again a function of location and where I've identified where we want to be. Now we looked so the way this all came about. Now I've always loved the outdoors. I've gone camping. I bring my family camping. As you know, there was this great opportunity that came in, and it happened to be at the footsteps of Olympic National Park, which is where we are right now. This deal came in. At that time, after all the experience launching the strategy at Stablewood, was looking for the next strategy. This deal came in, and I spent probably a month or so looking at it. You and I had bounced, conversations back and forth.
Yeah.
And then that's when we reached out to Brant and we, a couple other people in the space on the institutional side, and really got a lot more intel, more intel into what was going on in this space.
And I think for a separate episode, we'll talk about what you mean by we, right? You have a team at Firm Ridge around you that you've put together that's executing your first strategy and the subsequent strategies, or not the first project and the subsequent projects that you have within the strategy. Let's stick though to RV just for a second. So, and let's set aside your first project here at the foot of Olympia National Park. What is it that makes RV an attractive strategy? Like, why isn't everyone doing RV? Like, well, what makes it attractive, and why are others not doing it right now?
Yeah. Well, first off, so what makes it attractive? And for me, whenever I'm first looking at a strategy, it's you first look at the supply demand fundamentals, and looking at just the demand side, RV has exploded. Both RV ownership, RV rentals, the market has just gone. I mean, study that came out from RVIA, which is the Association for RVs, where I think they estimated 64 million people are going RVing this summer, based on a study they did. I think it was like, over 1,200 people. And so that demand has grown, and it's long term. There's all these new owners out there. And so that's the demand side. You flip over to the supply side, and that supply has not kept up. So you have, and there's data that, we'll probably get into in the next episode that shows this incredible supply demand imbalance. So that got me really excited about this.
Okay, so there's supply demand. What about pricing in this space? Like, how does it compare to hotels? How does it compare to hotels? How does it compare to, say, multifamily?
So what's really compelling about this space is that there's not a lot of capital here yet. And the locations, some of these, for traditional institutions, it's not a core asset class. You have a lot less competition with people coming in with low cost of capital. So there's incredible pricing opportunities, incredible attractive pricing opportunities on top of that as well.
So when you say it, what sort of cap rates are we talking? So stabilized RV. And when we say RV, I mean, I think we're really talking, it's like a hotel it's a ground lease hotel.
Yeah.
Like RV seems like I don't want to say a bad word, but it's.
Well, that's the beauty. See, that's the beauty of it. Say that, right? Because there's a
stigma from the investor community. It's like, oh, RV. I mean,
right. And then you look at the fundamentals of it, and you look at the public data, look at the REITs, look at what they're doing, look at the yield. If you actually get into the space, because of that stigma to it, there is that opportunity, and the stigma is going away. There's a lot of interest. It's just not there yet.
So it's not sexy. Of course, SFR, single family rental, wasn't sexy. I mean, that was the domain of the lowest common denominator investor. And no offense to any of us that have invested in single family rental, myself included. And now it's I wouldn't say the darling. It's overstating it, but it is firmly an institutional product type now. And so would you argue that RV will be an institutional product?
I would argue that it's on its way.
It's on its way.
It's on its way.
Come back to my question then about cap rates, pricing. So stabilized RV, and I'm sure that there are gradients of quality of RV park, but let's say what you're doing. How many units is what you're doing? Your first.
We have 100 units.
So 100 units at the doorstep of a bucket list RV or a national park. What sort of cap rate would one expect on a stabilized asset such as what you have at Footsteps of Olympia?
Yeah, probably 6 to 7%.
6 to 7%. And what sort of growth would one expect on top of that?
Yeah, so we are underwriting currently to what I strongly believe is a conservative 3% year over year growth, and there's a lot of indicators to say that it should be stronger than that.
Yeah. Okay. So 6 to 7, you add 3 on top of that. That gets you a 9 to 10 unlevered yield. You lever that with debt. What sort of debt options do they have in the RV space?
Yeah, there's traditional long-term fixed rate debt. Typical.
At what leverage level?
Yeah, you can go for RV. You can get up to 70%. Yeah.
So you lever that, and let's imagine it's probably priced a little bit more conservatively than market rate apartments. So let's say it's 250 over 10 year or something like that. And so your borrowing rate 6.5, 7 against a 9, 10 unlevered yield. So now you're your mid-teens gross levered IRR. What about on the development side? What are you building these to, yield on cost?
Yeah, so yield on cost on this first one, which is actually quite impressive. I think we're at an 11 yield on cost.
Okay, 11 yield on cost against a 7.
Yeah, so there's an
stabilized course. So
there's an excellent spread there.
So like a 400 basis point development spread. That's double what you'd expect in apartments. The other thing you said I found interesting was this idea of minimal capex.
Yes.
But on the development side, also minimal development costs. So your land is a larger share of the total. We'll actually come back to this. So what is involved in the development? Like, what are the improvements? If it's just land, you're just renting.
It's all the horizontal. And here's where the real interesting opportunity and both challenge. And we've experienced the upside and downside because there was another deal and we can get into those details as well.
Some of the other things you're doing.
So, what's involved is the typical, you buy, again, if it's raw land, you buy it, you entitle it, you assemble your team, you get your pricing, you get going, and you do the horizontal, and that's pretty much it. Now you'll build like a welcome center, or and you do maybe like a manager's unit on top of that, or things like that. But that's really it. So the development process is a lot more basic than it would be on, a typical, where you and I have come from, which is
what you were doing in San Francisco, your 80-story tower or whatever it was.
Right. And which is, overwhelmingly more complicated. So you have that simplified, right? And then the other amazing thing, this is an opportunity and a challenge, is the land entitlement component and the land purchase opportunity, right? Now, in some of the places where we're focusing on, like around bucket list national parks, land is harder to come by, and it creates a high barrier to entry. And, we bring on certain people on this team that actually have expertise in not only finding it, but actually potentially running it through this entitlement process. But you have the opportunity to bring sophistication and understand the value of land, and you could potentially outcompete or know something or learn something based on the sophistication behind your underwriting to potentially either pay more or discover something that other people haven't yet. So that's
interesting.
That's what we're finding.
So it's horizontal development, and for those who are listening who aren't familiar with what we're describing, horizontal development are really roads, underground, right? So sewer, water, electrical, cable, so forth.
Right.
And then you said that there's often an entryway, I would imagine, just like in horizontal. But you said there's some sort of welcome center, or what's?
Yeah, so people, when they show up to RV parks, they come in. Okay. They'll check in. It could be our center that we're building. And there's also amenities, by the way. We can talk a little bit about that. It's a welcome center. There's a gathering place, which is something that's really important as an amenity to have for people who come to RV parks. There's a lot of RV groups out there that like to assemble. So we have a large gathering space. This one will have hot tub, sauna, things like that,
Okay.
So anyway, that's sort of the things that you're building that you could say are a little bit vertical. So.
Oh yeah, that's fascinating. So what's the development time period for a park like?
Yeah, so we have this pegged out 6 to 9 months, and we have all our bids and we have all our subs, and that's so we really got it dialed in, and we're thinking. I say 6 to 9 months because we're at 6 months, but it's it's development.
So it seems like one of the downsides. Well, actually, let me just ask you. So the positive I hear from you. So I hear there's this supply demand imbalance. I hear there's attractive pricing at this moment because it's largely the domain of mom and pops, kind of independent operators. Reminds me a lot of self storage. 10 years ago, actually, the more you describe it. And your strategy in particular, where you're looking for sites in and around bucket list national parks, to use your term, seems compelling.
Yes.
And especially in light of the fact that our RV ownership is up, partly because of COVID, partly because of demographic trends. What are the downsides to this?
Yeah, and
where are your risks?
And there are risks. I mean, so let's talk about on just the development side, and then we can talk about some operational.
Yeah.
So on the development side, you're going out, and especially around these national parks, these are close knit communities, right? And so for someone to come in there, get control of a piece of land, and then bring that through entitlements, it's a little bit harder and more challenging on one hand.
That's interesting.
And then it's a mixed bag, because I said on the positive, on the other hand, there's some groups, some communities that are really looking for this opportunity. But we've experienced a lot of challenges just because of existing sort of small town bureaucracy. And it's not anything like when we go in there, there's no challenge on the relationship side. It's just
Well, you dealt with that in San Francisco.
To a greater extreme.
Sure. So barriers to entry on entitlement. That's one risk. Specific to, is that specific to your strategy or specific to RV? I mean, let's imagine you go to, name the place, Pennsylvania.
No, yeah.
Is it harder to get these entitled? Like, do cities not want RV parks?
Now, I couldn't speak for, no name town in Pennsylvania. Yeah. I'm around national parks, right? Yeah. Now that's a hit or miss conversation, because the challenge with RV parks is that, and national parks is that there's been so much growth in visitors around national parks that the highest and best use of the land is RV. And when you have all these visitors, you need more workers, you need growth in the community, but nothing's being built on the housing side. And so it creates this challenge, right? And so we've sought some creative opportunities on how to balance that, but that becomes a challenge in some locations, not all.
So does that mean you would have some proportion of your units permanent?
Now you could. Now the challenge is it has to pencil, right? So if you're getting the land at the right price and you can make that work, and then you can appease the town and provide housing as well, that's a tremendous win.
But now you've got to build those houses, which is increasing your capital requirements. And one of the attractive things that you're describing here is that this is fairly low capital. But okay, so what are some of the other downsides to RV?
So, for example, we're in a national park, right? And so for us in particular, you think about things like severe weather. We've had a lot of fires and things like that. Things that can impact your revenue stream are stuff that's becoming a lot more common. Yeah. So
what about the seasonality? Like, isn't this a business where you're only leased up half the year?
Yeah, well, you price that. That's in your pricing, so you back in.
But I guess the first question, is that the case?
Definitely. There's seasonality.
There's seasonality to it. So take your project here in Washington. Yeah. What sort of season? Are there months where you aren't leasing any of the units? You're entirely vacant?
I don't think that. Now, that's a function of not only the seasonality, but also what type of supply is in the market around here.
Yeah.
Around here on the macro, when you look at all the units, there's absolutely some vacancy in the off seasons, which around here is, November to March, April. Okay. Right. And then going through, then you have the shoulder seasons, and then really when you hit peak season, which is summer, it's gangbusters.
So you do have some occupancy. It's not like around Glacier National Park, where I would imagine the winter months you're closed.
Yeah, I would. It's between 25% to 30% of your revenue comes in on those slow months, and then the rest, your 70% of your your revenue comes in from.
So cash management is going to be important too.
Yes.
So seasonality is one.
Yeah.
What about just the transient nature of these things? I mean, your tenants are coming in and out every night. We can get to your team.
Well, let's talk about let's.
But like, isn't that a risk? I mean, the same with the hotels, I guess. It's a similar risk, but.
Yeah, I mean, as with hotels, the transient nature of this. But the interesting thing is that I wouldn't call this, and we talked about the big wave. I don't know if this is a decades-long big wave, but there's certainly a big wave we've hit, and we talked about this in one of our previous episodes, where there's been a fundamental change of human behavior, and one of those fundamental changes has triggered massive purchases, and massive, like, relative to what has gone on before, like hundreds of thousands of RV purchases, and this uptick. And I have the numbers which you could pull up, but in RV renters, right? Yeah. So you have all this happening right now, and again, that supply has never gone up to meet that. So you have and there's a website called Dirt, and they do this. It's like you can find any campground on Dirt, right? And they put out this study. And it's basically, one of the questions is, how difficult was it for you to find camping or an RV spot? And it was 5x. It's been 5x since 2019. I believe the numbers. And it's 5x. It's 5 times more difficult now.
I believe it. I'm in Colorado, which it seems like everyone in the country comes to Colorado every summer. And when you live there, you're local. You cannot find a camping spot.
Right.
I would imagine, I'm not an RVer, but I imagine you can't find an RV spot in the summer. And just driving around here, again, anecdotes as we were going to dinner and whatnot, and we see some of the comps that you've been showing, Sam and I. there's no availability. It's interesting. And I guess that it'd be interesting to come back in December and see what that looks like.
Right. And I think the key, and what I've learned here is that there's some quality products around here, but when you look at the expectation of how many RVs are showing up here, there's absolutely no way. I mean, maybe in December, there's no way that type of quality product that we're going to build is going to meet that demand, even in the colder months. Now, will we be fully occupied? I highly doubt we'll be fully occupied in the winter months, but I'm just based on all the numbers we've crunched. I'm excited.
We'll dig into your underwriting. I think it'll be interesting. Again, as a learning lesson for the audience, and also the curiosity of it. Well, good. Michael, very exciting. What I like about it, as I've listened to you over the last year, describing the strategy, I just love that it's not the strategy du jour.
Yeah.
Right. Everyone's in self-storage and multi, and it's just compressing cap rates to unrealistic levels, and there's no positive leverage. And this is a space that it feels like the fundamentals are strong, and yet it's not getting a lot of attention.
Yeah.
Of course, after this podcast, maybe you'll have more competition. Well, I apologize.
No, that's good. It's fine. I mean, the goal of what we do is to share and learn, and that's part of it. I want to add one final piece, is that, this is a hospitality industry. And when, forget about the numbers, forget about all that. When I was looking for something, this next opportunity, I had a bunch of opportunities come my way, and this came. And, I came out to visit this site. I went out to visit another site. I'm visiting national parks, and I was like, wow, my office is in these dream locations. And if I could be this passionate about this, then how many other people get that feeling when they come out and have these passion for these types of places? And around here, there's 3 million, look, the NPS has the data, there's 3 million. So it's not just, okay, this is a great strategy, let's go for it. There's like this energy around it of just passion, which is something that I get personally very excited about.
Well, you're tailor-made for this. First off, you went to the hotel school at Cornell. So, but yeah, personality-wise, your experience in the outdoors, your craftsman nature, I think is cool. In fact, let's be sure we have an episode where we talk about your team.
Yes, definitely.
So, Sam,
I got nothing to add, but I had a really good time listening. I mean, I like hearing the passion. I like hearing it's just an interesting story. Like, it's an interesting product type, and it has its own story. And like you said, 10 years ago, self-storage was this way.
Yeah.
Based on what we've seen just driving around, looking at the different projects, I can't imagine how, A, your strategy just doesn't go crazy, and B, how, like you said, maybe enough people will listen to this that you're going to have more competition than you want. But, that's what we do here at Adventures in Sierra. We share, and that is all good. So we'll see you guys on the next episode.
Thanks for tuning into this episode of the Adventures in CRE Audio Series. For show notes and additional resources, head over to www.adventuresincre.com/audio series.